in the quiet before the markets wake. The world's most powerful currency rests in the hands of a single nation. A currency that buys oil in Riyadh, technology in Tokyo, and wheat in Buenos Aires. A currency that has outlived wars, recessions, and revolutions. But beneath the surface, cracks are spreading through the invisible architecture of the global economy. And America's debt swells like a river in flood. History tells us, no currency reigns forever. The pound sterling fell. The guilder fell. The denarius fell. And when they fell, the world changed with them. Now, the question is not if the dollar will face its reckoning. It's how and when. US dollar devaluation. Brace yourself. In the heart of the financial world, the dollar moves quietly unseen, yet felt in every corner of the earth. Like a deep, steady river, the dollar carries with it the weight of global trade, flowing through markets, financing wars, binding together nations. Its power rests not on gold anymore, but on trust. Trust in the stability of one nation's economy, its laws, and its reach. But history reminds us, no currency reigns forever. The British pound once ruled these waters, until war, debt, and the rise of American industry pushed it from its throne. Today, there are echoes of that earlier fall. Inflation rises, debt swells, alliances shift, and nations begin to ask, what if the dollar is no longer the world's anchor? Gold passes $2,300 an ounce. Central banks buy it faster than at any time since the 1950s. More trade deals are signed in yuan, rupees, and euros. Each one a quiet erosion of the dollar's invisible empire. The river still flows, but its banks are wearing thin. Storm clouds gather on the horizon, and the current begins to pull in a new direction. Beneath the surface of daily transactions lies an invisible scaffolding, not made of steel or stone, but of trust, agreements, and intricate financial plumbing. At its center, the US dollar. In 1944, at Bretton Woods, delegates from 44 nations crafted a new order from the ruins of war. Currencies would be pegged to the dollar. The dollar, in turn, was pegged to gold, $35 an ounce fixed unshakable. In 1971, that anchor was cut. President Richard Nixon closed the gold window, ending convertibility and ushering in the age of fiat currency. But a new pillar was built. In the mid-1970s, Washington struck a deal with Saudi Arabia and OPEC. Oil would be priced only in US dollars. Energy, the lifeblood of the modern economy, became tied to America's currency. Oil exporters recycled their dollar earnings into US treasuries and assets, reinforcing the dollar's role as the world's safe asset. The system fed itself. Demand for oil meant demand for dollars. Today, that architecture faces new stresses. China signs oil trade deals in yuan. Russia builds its own payment systems. BRICS nations speak of a shared reserve currency backed by commodities. Economists at the IMF warn, reserve currency status depends not only on liquidity and scale, but on stability, rule of law, and global acceptance. Qualities now being questioned. Cracks are not yet catastrophic. The walls still stand, but collapse begins invisibly. Hairline fractures beneath the paint, shifts in the foundations, until one day, the structure can no longer bear its own weight. And when the flood comes, it comes without pause. Debt swells, pressure mounts, and the river threatens to overflow. Debt swelled like a river in flood. At first, it was a trickle, unnoticed, but decade by decade, the current grew stronger. The United States debt now exceeds $34 trillion, a number so vast, it drifts past the mind like a cloud, real, yet difficult to grasp. We have been here before. The 1980s defense surge, the 2008 rescue packages, the pandemic relief of 2020. Each time, the levee held, but the water rose. Some say a sovereign currency cannot run dry. That money can always be created to meet obligations. Modern monetary theory calls it sustainable, so long as inflation remains tame. But interest rates have risen. In 2024, the cost of servicing the debt rivaled America's defense budget. A silent shift in where the nation's money goes. Foreign buyers, once the eager backbone of the treasury market, are stepping back. The Federal Reserve and domestic buyers now fill the gap. Floods do not always break levees in a single night. Sometimes the erosion is slow, until one day, the wall gives way. And beyond the flood lies another battleground, not of water, but of strategy. On the grand chessboard of global power, the US dollar has long been the queen, swift, far-reaching, decisive. Through sanctions, the dollar became a tool of influence. It could freeze assets, cut nations from the global system, cripple economies without a shot fired. But every use of this weapon sent a message. Dependence on the dollar carries risk, and some began building ways to escape it. History shows that currency dominance breeds resistance. The Soviet Union built its own networks. Nixon's gold shock forced nations to adapt overnight. Now BRICS nations speak of a shared reserve currency, backed by commodities, free from US control. The strategy is not to attack the queen, but to build fortresses. Each new bilateral deal in yuan, rupees, or reals makes the dollar's reach just a little shorter. The danger for the dollar is not removal from the board in one move, but being surrounded, its power diminished until it is no longer decisive. And the markets are already showing the first signs that the reflection is no longer perfect. Markets are mirrors, reflecting not just numbers, but the mood of millions. Sometimes calm, sometimes warped. In recent months, the reflection has shifted. Gold climbs above $2,300. Oil trades in currencies other than the dollar, and investor sentiment begins to tilt. History warns us, before collapse, the mirror distorts. In Asia, 1997. In Argentina, 2001. The market knew before the public did. Investors follow the herd. A few small shifts, a trade deal here, a swap there, can become symbols of a larger break. Yields rise with gold, an unusual pairing. It says the safe haven is being questioned. The mirror has not shattered, but frost is spreading, faint and intricate, until the whole reflection is changed. Confidence is the currency behind the currency. Without it, paper and digits are nothing. When confidence breaks, it is sudden, like thin ice giving way beneath a single step. The ruble in 1991, the mortgage market in 2008. In both, trust vanished before the numbers did. Central banks diversify. Trade bypasses the dollar. Alternatives emerge, quietly but persistently. Keynes said value comes from belief. Monetarists warn, oversupply without productivity kills that belief. Both agree, once belief fades, recovery is hard. A single shock, geopolitical, fiscal, or market-driven, could tip the balance, and the rush for the exits would be swift. The ice still holds, but each creak is louder than the last. And when it breaks, there is no turning back. Empires rise on their currencies and fall when they falter. Rome's denarius, the guilder, the pound sterling. The dollar still stands, its books in balance. But the cost of holding that balance grows heavier each year. Inflation bites quietly. Debt costs swell. Allies hedge. Adversaries build alternatives. The shift is slow, until it is not. History does not repeat, but it rhymes. The dollar's fate will be decided not by size, but by trust. Balance is not permanence. It is the stillness before the tide shifts. And when it shifts, the cost will come due. The dollar has been here before. Will it survive again?